Welcome to What Are BDCs? The ultimate guide to business development companies. This video is designed for curious learners, financial beginner, and anyone curious about alternative investment vehicles. We'll explore business development companies, explaining their unique structure, regulatory framework, and their crucial role in bridging the gap between everyday investors and the lucrative world of private market investing. By the end, you'll have a comprehensive understanding of how BDCs can potentially enhance your investment portfolio, while also being fully aware of the associated risks. At its core, a BDC, or business development company, is a type of publicly traded investment fund that invests primarily in small and mid-sized private companies. Unlike traditional private equity funds, BDCs are accessible to retail investors through public exchanges, offering a unique gateway to private markets. BDCs were born out of the 1980 Small Business Investment Incentive Act. This legislation aimed to stimulate capital flow to American businesses that often struggled to obtain financing from traditional sources like banks. Their primary purpose is to provide growth capital, typically in the form of debt and equity, to underserved middle-market businesses in the U.S. These are companies too large for micro-lending, but often too small or specialized for traditional bank loans or public market financing. A key differentiator for BDCs is their publicly traded nature. This means individual investors can buy and sell shares of BDCs on major stock exchanges, much like any other stock. This accessibility stands in stark contrast to traditional private equity funds, which are typically only available to large institutional investors or ultra-high net worth individuals through large, illiquid commitments. Now that we understand what BDCs are, let's dive into how they actually function, covering their structure, capital pooling, and investment rules. BDCs are structured as closed-end investment companies. Crucially, they are regulated under the Investment Company Act of 1940. This act provides a robust regulatory framework that mandates certain operational and reporting requirements, offering a layer of investor protection not always present in other private investment vehicles. This SEC oversight means BDCs must adhere to strict reporting requirements, including regular public filings and disclosures. This transparency is a significant advantage for retail investors, providing them with detailed information about the BDC's investments, financial health, and management. BDCs pool capital from a diverse range of investors. This includes not only retail investors like you and me, but also institutional investors, such as pension funds, endowments, and even other investment firms. This collective capital forms a substantial pool that the BDC can then deploy into various private companies. Once the capital is pooled, the BDC's management team strategically deploys it across various debt and equity instruments within private companies. This includes providing loans for expansion, acquisitions, or working capital, and sometimes taking equity stakes for potential upside. A defining characteristic of BDCs is the 70% investment rule. This regulatory mandate dictates how BDCs must allocate a significant portion of their assets. It's a cornerstone of their design, ensuring they fulfill their purpose of supporting middle-market businesses. Specifically, a BDC must invest at least 70% of its total assets in eligible U.S. private or thinly traded public companies. These are typically businesses with market capitalizations below a certain threshold, or those that don't have widely traded stock. This rule is crucial because it ensures that BDCs remain focused on their core mission, providing capital to small and mid-sized enterprises, or SMEs, which are often underserved by traditional capital markets. It prevents BDCs from becoming generic investment funds and maintains their unique role. BDCs employ a range of investment strategies to generate returns, primarily focusing on debt and equity investments in private companies. Let's explore the common types of investments they make. Senior secured loans are a cornerstone of BDC portfolios. These loans are typically backed by the borrower's assets, meaning if the company defaults, the BDC has a priority claim on those assets. This makes them lower risk compared to other forms of debt, and often comes with floating interest rates, benefiting BDCs in rising rate environments. Mezzanine debt sits between senior secured loans and pure equity in a company's capital structure. It's unsecured, making it higher risk, but it comes with higher yields and often includes an equity kicker warrants or options that allow the BDC to convert a portion of the debt into equity, offering additional upside potential. Beyond debt, many BDCs also take minority equity stakes in the companies they lend to. This allows them to participate in the growth and success of these businesses, capturing significant upside if the company performs well. These equity investments often provide a significant boost to overall returns. One of the most attractive features of BDCs for investors is their unique tax structure, specifically their regulated investment company, or RIC, status, and the associated 90% distribution rule. These provisions lead to compelling dividend yields. Similar to REITs or mutual funds, BDCs are granted RIC status under the Internal Revenue Code. This means they are exempt from corporate income tax, provided they distribute at least 90% of their taxable income to shareholders each year. This avoids the double taxation that typical corporations face, where profits are taxed at the corporate level and again when distributed as dividends to shareholders. This 90% distribution rule is the primary reason why BDCs are known for their high dividend yields. They are essentially required to pass through the vast majority of their earnings directly to investors, making them a popular choice for income-focused portfolios. The performance of BDCs is closely tied to interest rates, particularly given their reliance on floating-rate loans. Understanding this relationship is key to assessing their potential in different economic environments. BDCs offer several compelling advantages for investors looking to diversify their portfolios and access new opportunities. Let's explore the key benefits. One of the most significant advantages is democratized access to private credit and private equity-style returns. Traditionally, investing in private companies required substantial capital commitments and exclusive networks. BDCs break down these barriers, allowing everyday investors to gain exposure to this lucrative market segment through publicly traded shares. As discussed, BDCs are legally mandated to distribute at least 90% of their taxable income. This results in a high, consistent income stream for investors, often paid out quarterly or even monthly, making them highly attractive for those seeking regular cash flow. Compared to direct private equity or private credit limited partnership commitments, BDCs offer simplified entry. There are no large minimum investment thresholds, shares can be bought and sold daily on exchanges, and tax reporting is straightforward, typically via a Form 1099, avoiding complex K-1 forms. While BDCs offer attractive opportunities, it's crucial to understand the inherent risks. Like any investment, they are not without their potential downsides. The BDC market is robust and includes several prominent publicly traded companies. Knowing some of the major players can help in further research. Some of the largest and most well-known BDCs include Hercules Capital Corporation, or ARCC, Main Street Capital, or Main, Hercules Capital, and Blackstone Secured Lending Fund. Each has a slightly different investment focus and strategy, but all operate within the BDC framework. Looking ahead, the BDC landscape continues to evolve, and their role as a vital bridge in the financial ecosystem is only becoming more pronounced. The BDC industry has seen significant growth over the past decade, driven by increasing demand for private credit. Regulatory evolution, such as efforts to streamline co-investment opportunities, continues to shape the market, potentially leading to even greater efficiency and a wider range of investment results for shareholders. Ultimately, BDCs serve as a critical bridge. They provide essential capital to middle-market businesses, fueling job creation and economic growth. Simultaneously, they offer retail investors a unique and accessible avenue to participate in the private markets, providing liquidity and an attractive income stream that was once largely out of reach. Thank you for watching What Are BDCs? The ultimate guide to business development companies. We hope this in-depth explanation has provided you with a clear understanding of these unique investment vehicles. Please remember, this video is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial professional before making any investment decisions. Your financial future is important, and informed decisions are key.